Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, January 3rd, 2023. It's 12:12 p.m. Eastern Time as I'm starting the video, so we're about halfway through the first trading day of the year. What I'm going to do is an update on the equity markets, just kind of brief overview. Really, not a whole lot has changed technically since we ended the year. But I'll do a brief overview and then an update on gold and silver. I'll try to squeeze that in here as well. Won't do too many. I'll cover other commodities and treasuries in separate updates. All right, bigger picture. Let's start with the big picture. This is the S&P 500 weekly chart, and the big picture is this. This is our primary bear market downtrend line. That's off the all-time highs right there. The bull market highs, it ended the end of last year, around early 2022, right around the first of the year, and we've been in a clear downtrend since with a lot of distinct reactions, including the two most recent objective shorting ops we had, and there's the 40-week aka 200-day moving averages also rejected there. So from this long-term perspective, nothing has changed. I'm still favoring another leg down in the bear market. And just eyeballing this, you can see the impulsive move down after the last rejection off the trend lines, the downtrend line, and it looks to be potential flagging action. Now, this is long term, all right? That's, again, I always try to I do my best to differentiate between swing, long term, less active swing traders and trend traders, and those who might be more inclined to be active traders. So from the bigger picture, swing trend trader, nothing's changed. And if we get a big impulsive drop through there, if this is a flag right here, it certainly takes that shape. Again, with the impulsive leg down, then what you'd want to look for as a sell signal would be a solid candle through there. Now, this is a weekly chart, so ideally you want to see a weekly close through there. If so, you take to get the measured target of any flag pattern, any bear or bull flag pattern, take the length of the flagpole. In the case of this bear flag pattern, it's the move leading down to the flag, add that to the highest part of the flag, and you can see that would take us right around to that first, that was my first long-term target, bear market target, and it was already hit back here. When we hit that, we put in positive divergence, and that was a catalyst for this rally. The other thing to look for, again, that hasn't happened yet, sometimes you get these flags that just don't pan out and you move up. Well, you still have the 200-day / 40 weeks, and you still have the downtrend line as resistance. The other thing to look for, too, would be a bearish crossover here on the PPO. That's a pretty darn good trend indicator. You can see if we go back in time a little bit, the last bearish crossover was right here. Oops, that is not an that was a freehand tool. Let me do an arrow tool. Click on that and go up. There was our last bearish crossover was right about here, and that gave us that leg down. Before that was all the way back here when the bear market started. So pretty solid stuff. And that's going to increase the odds that we are going to head down to these deeper targets there. Again, we had that was only two of those before, and so if we get this one here, that's going to be a trend change indicator. And you can see once the lines cross, the PPO line acts as support or resistance when tested from above or below. In that case, in other words, back here, we had a rejection. Now, that could happen here. So sometimes the lines, they kiss and then they bounce. Remember that signal line, the white line, sometimes will act as support. So these are things to really, we're not going to know today. We're not going to know till at least Friday if this plays out as a bear flag. Now, that's all long-term stuff. Let me just give it to you on QQQ as well. QQQ weekly chart also, primary downtrend line. Oops, I don't know what's going on here with my drawing tools today. Working off a new PC and updated the software recently, but here we go. 1, 2, 3, 4 beautiful tags, 4 beautiful, well, let's say once the downtrend got started, 3 beautiful objective short entries for trend and swing traders, and those are clearly profitable. And if you zoom in, or this one I should say is clearly profitable, same thing, a little bit of flagging action there. Let me get rid of this freehand tool, pardon me here. Let me just put a little another circle tool there, something in place. I keep clicking on the wrong tool. So there it is. That is a potential bear flag, a flagpole there, potential flagging action, and also a pending or potential bearish crossover on the PPO. Last one we had there, last bearish PPO crossover, and before that it was just like the S&P 500 right when the market started. And then these are bullish crossovers. We got that one right before that rally, and we got this one right here before this rally right there. It came in the fourth quarter. So pretty good trend indicators to watch, pretty reliable. Now I'm going to jump all the way down. I'm going to skip the daily. Let's hit the daily just to show you we're still above the previous lows. And if you turn off all the lines, you can see again this looks like potential flagging action. And so I know a question might be right now, well, why do you keep throwing out these long setups? I do that as I've done, as I will continue to do for active traders. There's still the potential for a bounce here. The 60-minute chart is one of my favorite active trading or active swing trading time frames. And I've just over the years have been conditioned to respect, identify, and respect these divergent lows. Divergent meaning positive divergence. Now, like I like to say, these are not the be-all end-all. There are no guarantees. And most importantly, and let me just say that again, most importantly, in a primary downtrend, aka bear market, bullish setups, and that includes this bullish falling wedge, positive divergence, any other type of bullish chart pattern, reversal pattern, has a lower chance of playing out. But again, if you fail to respect these, then quite often you're going to give back a lot of profits being short or miss out on a rally long. So I've highlighted each and every one of these divergent lows, divergent low. That one was a nice rally, ended with a divergent high. It was just a quick counter trend bounce, put in a even bigger divergent low. And these are rallies that again, for the active trader, that was about a 12% rally right there off the October lows in QQQ, followed by, you got it, it ended with a divergent high, negative divergence right there, overbought conditions. It was a small divergence, but it worked. Another little small divergent high put us down here, and there it is. So that's a divergent low. It's not labeled there as such. I'll just duplicate this and I'd move that up, grab that writing. That was a divergent low as marked with the positive divergences, and that one was good for a 13, well, really before all said and done, about a 15% rally off that divergent low. And that ended with a divergent high. So again, this is the active trading time frame. And if it confuses you when I'm throwing out long setups, but yet I still, even personally, I told you I headed into the new year with swing shorts on my long-term accounts, and I've taken hedges. I haven't yet removed those hedges, the Apple and Amazon stocks. They're indirect hedges. Direct hedge would be, let's say puts on QQQ if I'm shorting the Qs. Indirect hedge, which I prefer to do if I am short or long an index. If I'm short the index, I'm going to go long the most bullish looking stocks in that index. Because to me, a direct hedge, it's just a washout. Might as well just go to cash and go nowhere. And so if you play it right, there are many times where you can take those indirect hedges. And so let's say, for example, and that may not happen, and I'll probably pull those hedges soon if we go much lower. But if you are, long, as I am in my active trading account, long the NASDAQ 100, or I'm sorry, nope, go back to the swing accounts. That one I am long. Short the NASDAQ 100, but then long select stocks like Apple, Amazon, Tesla, and the market does rally, then hopefully those individual names, which I believe so, Apple, Amazon, Tesla, will rally more. Tesla's getting hit hard today. I'll get to that one in just a second, but let me show you. Here's what I think is the most important thing to watch right now, especially for active traders, and it could impact less active swing traders, even trend traders. So you have this bullish falling wedge. Again, nothing new. I highlighted, last week. There was a breakout. It was an impulsive breakout, rallied up here to that first target / resistance zone. 267.36 is where I have it. There was a brief pop. This is why I always say whatever time frame you're trading off of, whether it's a 5-minute chart you're very actively trading or a weekly chart as I started with in this video, the most important thing is how that candle for that period closes. So this was a pop into there, but then only to close back down. We got rejected. And remember, and this is another thing that I always harp on, and I'm a big proponent of, is even if you don't trade futures, even if all you trade is QQQ or SPY or whatever it is, always watch the charts of the futures, because as I pointed out to you this morning, at the very same time you can see QQQ pop that at the open, and there was also a gap there. I could have had that on there. Always traders always look for these gaps. That was basically right there is your gap. That was a test of the bottom of the gap and a rejection there. But let me grab that NQ chart. I have it over here. There we go. At the very same time, that's one of my NQs. I have two different charts. Let me pull up this one here, NQ. I have two different boards. This is the one I got out to you last week, and I updated these. I resequenced the targets. That was this morning right there. So we hit it in pre-market. That's about 11,173. Pretty decent resistance. And that's what I said we need to take out for the next buy signal. So at the very same time, QQQ made a test of the bottom of the gap. That was a second run at and failure. We got a rejection there. That's why I said the next buy signal would have to come on a break above that, and a solid break, not a little tap. It's like I said, I called it 11,175 in the post this morning. So there's a rejection, and that's basically it's a non-event. It's a non-buy signal. It's another rejection at resistance. It helps to validate that. I'll tell you that right now, because now you had a tag earlier this morning. You had a near tag there. Obviously, the line's there for a reason. There were other multiple reactions, including this last reaction high there where it stopped. And so that's a big level. If taken out at this point, it will. I have even higher confidence it will run up here to these higher targets if taken out. But again, if is, like I said, there's a difference of trade setup and an actual trade. Now, what we did since then is we took out, and I'm not crazy about it, this downtrend line. So I highlighted that. There was a little minor trend line there, not a lot of reactions. This one had a few more, and we're just below it, but by a hair, and we're also right on, or just a hair below this 10,000, about 890 support level. Here, I'm going to zoom in for you so you can see it there. And you can see we also had negative divergence, at the highs there today, right here on the indicator. So we are below it, and that is bearish unless we recover that. That's bearish. So as I mentioned, if you took a shot here or at that 11,892, that would be a tight stop, and that would make sense. You can always jump back in. The maximum you want to give it, if we take out the lows, that's not going to be good. But what I always say is the charts are dynamic. So if and when we get there, let's just say we do have even bigger divergence, and then you get a reversal, because that's what this market has been plagued with. Almost every bottom we've had has been an undercut of the previous lows followed by a reversal. So that is your buy signal, not just a break of the lows. If you reverse back above, and especially if you still have some positive divergence here on the 60-minute time frame. So, okay, bigger picture, nothing but bearish. I'm not waffled on that and wavered. That to me looks like we're going lower. If and when that changes, I will let you know. Near term, we've had the opportunity or the potential to pop this first resistance level, but we didn't do it, so we got rejected. Then the buyers had an opportunity to step in here, and they haven't so far. But here, look at this. We're right there. It's the previous reaction low. And again, me personally, I am not, in fact, I actually added to those indirect hedges today, because I do think we're going to get this. I think this is just, remember, this is the first trading day of the year. The headlines, my goodness, I haven't looked at the sentiment surveys. I need to do that, but just reading the headlines over the holidays, I mean, now everybody's on the bear market train. So I'm still favoring a rally, guys, at this point in time. And I'm not married to it, but still giving it some room on those hedges. And what I'll do, and I think I shared this with you last week, should the market just crap out, I will remove the hedges. I will sell Apple, sell Amazon, but as of now, in other words, that would keep me raw short, no hedges. But as of now, I still think there's a decent chance. If you look at this QQQ 60-minute chart we're on right here. Let me grab my box tool, and that would be frame tool. Here we go. Remember, we had this period of consolidation right here recently. We broke down, and that proved to be a whipsaw. And I must have said it 100 times. Me personally, got back trading. The trading between Thanksgiving and New Year's is very tough. It's plagued with whipsaw signals. You have low volume. Traders are on vacation. People are on vacation, and the algos can just have a field day. And it's not only that. You also have a lot of year-end position squaring, tax loss selling. But what we did is when we undercut that low, we pretty much tested the previous low. So you want to look at it this way right now. That's a pretty important low because we have the potential of an uptrend here. You have a series of higher lows, or at least equal lows, and higher highs so far. So if this low holds, then that's going to be near-term bullish. All right. If it gets taken out, not good, obviously, especially if that low gets taken out. And then again, watch the weekly charts for those signals. The weekly has a higher weighting, in my opinion, except anything that happens between now and Friday on that weekly really doesn't count, if you will, unless it's a huge move down. One that, let's say, we're going into midday Thursday, and we're so far below the bear flags I started out on the weekly, so far with a solid PPO bearish crossover, that there's very little chance of recovery. Then you can usually say, you know what, there's a very good chance come close Friday we're going to have those sell signals confirmed. But as of now, that's not the case. What I see is, I'm going to zoom back in. I see a recent successful test of the previous lows, which were, again, higher than the low before that. That's what I see right now. I'm trying to be as objective as I can here. I see, some consolidation in that range, and then a pop back in. I talk about this often. Once you re-enter a trading range, it is very common to go back to the top of that range as soon as you re-enter it, and that's what we did. And then back down to the bottom. So this is it. This is right now probably the most important thing to watch on QQQ, and we're flirting with the bottom of that range. And you can see there's a few spikes down below it, and that's it. If we cannot recover it today, then this is probably what we're going to do. If we can recover it, then we go back to the top, and then I think based on this, again, kind of near-term stuff, I'm talking here just days to maybe a couple weeks, bullish falling wedge, breakout, and if we can pop this level again, I know we popped it once, but if we pop it again, there's no business. I think there's a lot of stops placed above there now. We'll shoot on up to these next targets, including my maximum bounce target, 280. Again, I like to repeat myself. I know there's new people coming to the site all the time. The targets I'm showing you are unadjusted targets. They're actual resistance levels. So if you're targeting 280, don't set your sell limit order at 280 if we happen to get there. You want to get out early just in case the sellers step in early, because they usually will when you see a very good level like that, very well watched. So sell a little shy. Now, and if we go down, then like I said, really at this point, I turn my focus back to the weekly chart on QQQ. I'm rolling back over here, and there's my next target. I haven't waffled on that since the beginning of the year, 235-ish, again, ish. We'll see what the charts look like if and when we get there. But as of now, like I said, despite what is some pretty compelling evidence, including the recent rejections there at the 200, I suspect that we could get, and again, it's pretty simple. We need a pop. We need those buy signals that I gave you this morning, which come back to, I'm really focusing more so on NQ, but also QQQ needs to do it. This is the NQ 60-minute chart. That's it. So right there. So if we can pop 1175 with conviction, solid move up above there, especially a 60-minute close above 11175, excuse me, then that's most likely going to give us a near-term rally, which would allow active traders to gain a quick bounce early. I think we'll see some buyers step in here. That's my thoughts in the beginning of the year. And if not, then I'll pull out those hedges and if and when I'm convinced that the rally's not going to happen, and then would have given back a little bit of the profits on the shorts by having those hedges in my long-term accounts. But right now, in my active trading account, I'm still like I said, we're really pushing the limits of what I want to see it do, but we're right there. We're at that trading range, and so I'll give it a little bit more room. And who knows, it's possible by the time this video gets out to you, I'm already out of it. One thing I'll say, with the new computer that I have now, I told my son, he builds PC gamer computers, and he built me one over the holidays with the latest and fastest processors and all that. So I can upload these videos. They just rip right up now, and I can get them out to you usually in fraction of the time it used to take. So they won't be as dated anymore. If usually could take up to an hour depending how long the video was. Now I can get them out to you within usually half an hour or less. All right. That's it. Oh yeah, another one I wanted to show you too was RTY. If the large caps can rally, the small caps will probably as well. So I gave you a setup there as well. And just like that, I said you had to take, even though I had a line at 1796, I said 1800. You want to take out 1800 and the level I just covered on NQ, and that didn't happen. So there's a good example of a trade setup that's still not triggered, but still has the potential to trigger. And I smell a late day rally. I think we'll shoot on up here today. And if we get back there again, I think we'll pop it. That's my thoughts. If we get another run up to test it, my guess is it will not be much longer before we just pop it and then run up. And I gave you, that's my max bounce target, 1921.50, which is from where we're at now about 9.5%, almost exactly 9.5% from where we're at now. So that's why I share the short-term setups. Again, for either an active trader or even maybe a more typical swing trader that might not want to give back 10%, and then on, what was it, on QQQ? And QQQ, 60-minute chart from where we're at now, that max bounce target 288, that'd be about 6.5%. And, so on, as far as IWM goes, if QQQ gets here, then I'll close out. I took some RTY shorts today, shortly before the video. Then we'd be, RTY longs. That is the small cap stocks. Because again, as I showed you, I got a post out to you after the open today. Although I was showing you those buy points that didn't trigger, I also showed you where on the second video, I'm trying to cover a lot today, guys, and it's early in the year. The last screenshots, static charts I showed you, you can buy here on this pullback to that 10,000. It's about 10,890 support, and again, right below the trend line, close enough that I think that's going to be a whipsaw. And if we can regain it and we bounce off this level, again, I think we can rip on up here, and probably. This would be, if you just want a quick if we do get a big rip this week, probably that's our first reaction. We may blow right past T2 is what I suspect. Yeah, that's what I wanted to share. So T3, probably that's where the sellers would step in at first. If, again, big if, but if we can hold here, and let me try to measure it for you, that would be right at about 5% from where we're at right now. So not a bad trade if it pans out. All right, I told you I would give you an update on gold and silver and all those. Let's look at the U.S. dollar. Let's start there, USDOLR. Dollar index, remember, gold and the dollar move inversely to one another. It means one goes up, the other goes down. This is what the dollar index looks like. This is our primary uptrend line right here. If you recall back here, I pointed out a divergent high. And then a trend line break to watch, and to give us a sell signal. We got that sell signal. We hit my first target, bounce as expected, hit my second target, which was a trend line. I think, did we even have a reaction there? No, went right on through there, went on down to this level here to 968, bounced back up to the third target, and then you can see the lines are clear, very well defined. That's a very good support level right there. And then the downtrend line is just above. So what happens if the dollar will either bounce here off this support, I believe, or if it heads on down here, possible that it could cut through the trend line. If it does, there's really nice support there, but I can see some positive divergence. Where I'm going is I still suspect we're close, very close to rally. Look, this downtrend in the dollar was expected. That's what gave gold and silver the nice rallies they've had for the last couple months. The drop in the dollar and rise in the euro. but now I'm looking for a reversal soon, a tradable bounce in the dollar. Again, whether it entails one more thrust down or not, you can see the divergence setting up down here on the indicators, and if so, gosh, trying to grab a line tool. There it is. So that would show us a little more downside there in the dollar. And if we do get a little more downside in the dollar, it's going to mean a little more upside in gold and silver. There's gold right there. Here's my lines. So you can see gold is at this. I've had these lines on here forever and a day. So this is an old resistance zone about 174 to 172, which we're at right now. We've got a little doji forming, potential topping stick. And so again, gold's been slogging up. The strong move was right here. That's when the dollar really started to correct and the euro started to rise. And the rate of ascent has slowed. And so we're at resistance. Just to be clear, I remain longer term bullish in gold and silver. But near term, like I said, maybe a little more, one more thrust up in the dollar maximum. If so, we could get could carry us all the way up here to about 179. But at any point, I think that reversal in the dollar can come. And then what you want to watch for, if you break this uptrend line in gold, that could send us back down. If it sends us down, being that I'm long-term bullish, any or all of these support levels down to, but not below 158. I don't think we'll get all the way back to 158. But any pullbacks to any of those support levels would provide objective long entries or add-ons. Silver, SLV, same thing. It's wedging higher here. You've got a pretty clean uptrend line. You've got major long-term or intermediate-term downtrend line resistance right there. So you're at resistance with this wedge pattern there. You've got some divergence building here. And so I'm leaning towards a correction here in silver. Love to see it come back to about that 2060 level. I think that'd be a great buy point. And if you trade futures, silver, you just get a little more bang for your buck than gold. When gold rallies, silver will usually rally right along with it, and it just goes up more in percentage terms. So here's this is a 6-month chart with 2-hour candles. And just like that daily chart, you can see we're diverging here. We've got this little wedge. So this is where you want to set a price alert. I think I covered this last week. On a break of the trend line, but to be safe, you need to see silver take out 23, about 23.65. If so, that would probably bring us down to at least this 22.361 level. Okay, that's it. Like I said, I'm just going to stick with the markets and the precious metals in this one. So that's where we're at.
Market data connection lost.
I did tell you that I would cover those Apple, Amazon, Tesla. So Apple, not good. Remember last week, and I told again, holidays, whippiness, we had broken the previous low right there, which is about 129, give or take. And then I said not quite recovered it. It was a back test that we'd have to build on those gains. And so basically that back test, we saw a rejection today. That's not good. That's obviously bearish until and unless Apple can recover that. All right. Let's just not overanalyze it. It is bearish right now until unless it can recover it. If it does, you have the potential for a nice run in Apple. So that's why I'm still hanging on to this one in the long-term accounts. You have potential positive divergence. We have not made, the PPO needs to turn up, and it needs to do it now. So Apple's gonna have to keep this chart really constructive, needs to reverse soon, take back that 120, I'm gonna fix that says 128.99. Everybody loves round numbers, so 129, and of course the recent highs. Let me zoom in a little bit. And if so, then the potential for Apple is pretty darn high. It would take us all the way up to at least this area here. This is still my target. It'd be about a 10-11% rally to the downtrend line in that 137, 138 area. That would be a potential bounce target for Apple. And if Apple bounces 10%, the market will bounce. That's just a given. The other one I liked, actually even liked more, was Amazon, my favorite. This is where my heaviest hedge. And that one's still looking good. If the market craps out, it's going to take a good looking chart down with it. Don't get me wrong. Amazon, all the fangs, they will get dragged down kicking and screaming with the market because of the simple mathematical weightings. When the sell programs hit and the algos and individuals and the funds are dumping SPY and QQQ and the futures, everything gets sold down proportionally. So you're going to most likely, anything's possible. I've seen one fang go against the grain from time to time, but for this to happen and Amazon to rally, and the target would be up there about 101.50. We're going to need to see the market, those potentially bullish developments I covered earlier play out. So there's Amazon. Otherwise, it craps out here, and especially if it goes down much below there, then it's broken very good long-term support, which is about $83 right there. So, from a long-term perspective, I know, like I said, the case for the bear market and being short is very strong. There's Amazon's downtrend line. There's a 200-day / 40-week moving averages. It keeps getting rejected off of, but it's at long-term support with potential divergences there. And even on the 60-minute chart, you have positive divergences. And again, so that's what I'm doing. I'm pointing these things out, and I'm telling you that in a bull market, you want to go along with both fists when you see these 60-minute divergent lows. In a bear market, even they usually do play out, not for as big a rally as they play out in a bull market, but that was our last divergent low right here on the 60. No, that was our last divergent low right there. Let me just measure that one for you. And that was still a 12.5% rally, right? So not bad. This divergent low gave us about a what is that, 40-something% rally? Yeah, over 40%. So there it is, guys. That's why I'm still, I'm mixed feelings, believe me, because the long-term charts are so darn bearish. But these charts certainly have the potential to give us a nice rally in these stocks. So it's kind of do or die time, if that makes sense. I mean, they've really got to giddy up now. Ooh, Tesla. Remember Tesla I showed you had a potential selling climax. We had big volume, that plunge into the end of the year. Ooh, we undercut that low. That's not no bueno. Now, if we can finish the day up green above that previous low, and if the market's going to rally like I think that's going to happen, and there's still the potential that this is all bottom here, and we're just relatively slightly below that. I'd say relative. Remember, Tesla moves big. So when you say, "Wow, Randy, the stock's dropped," in the last day or two, 15, 14%. It's all relative. The drop from the beginning of the year was 74%. And if you look at where Tesla was at the end of 2020 or mid 2020 right here, the stock rallied 3,260%. Okay, so that's what I talk about, beta adjusting position sizes. If you trade Tesla, just as if you're a commodities trader and you trade natural gas, you put a whole lot less into those positions than you do on a more stable, steady Eddie, blue chip stock like Procter & Gamble or Walmart, because of their inherent volatility. It's not unusual for Tesla or natural gas to go up or down double digits in a single day. But it is unusual to see Procter & Gamble or Coca-Cola to go up or down double digits in a single day. All right, I'm going to wrap it up here, and I will certainly do a end-of-day market wrap. This has been Randy Finney with Right Side of the Chart. Have a good one.